Hello.
Hey, Mike. How are you?
I am doing all right. How about yourself?
I am doing well. Give me 1 second here.
Yeah,
There we
I'll shut my door. Trying something new here with Jory producing the show.
go. Yeah, a little more polished, streamlined approach, or what? Not that I think it's fine.
Are you saying I wasn't polished?
Not at all. Not at all. We don't get paid for IT, so.
This is true. Another limit day. How fun is this, right?
Well, it's funny. Limit in May, limit in July. March is only up 2180. And
Yeah.
obviously, no limit in March, but you finally are seeing these back months, and we'll go over this, just how the back months have kind of gotten left behind here.
Well, we're in a different world today. Uh, it's amazing how a conflict, geopolitical, can change the landscape kind of overnight.
Yeah, yeah, no, it's I've been long crude all along, crude calls, and kind of seeing the writing on the wall, and you hate to profit off of somebody else's misery, but I don't think there's a quick fix for what's going on unless somebody assassinates Putin or takes him out. I don't know how he backs down and saves face.
It's a strange one. I'm surprised by a couple of very esoteric things. One being Switzerland, actually throwing their
Yeah.
hat into it politically. That's kind of new ground. Um, and I've actually been surprised with China not being as robustly behind Putin.
Well, the third leg of that is Germany boosting their GDP spending on military now, where they kind of stepped in and supplied missiles to the Ukraine, so that's another one that how do you unite the West? Well, obviously Putin has done a masterful job here so far of uniting his Western counterparts, unified against him right now, where you pretty much pissed everybody off out there right now.
And I saw something yesterday about Norway and Finland looking to join NATO now as well.
Yeah, yeah, I saw, with his military threat of "you're next," I think it's spooking the herd. Um, and I know, the Ukraine symbolically asked to join the EU right now. They signed that declaration, I think, yesterday or the day before, to where, again, I'm not sure. Russia's got this playbook, military playbook. When you look at, what they did in the 80s in Afghanistan, what they did with Crimea, what they've done in Syria, where it's this mass destruction, kill civilians. And with this being on social media, it's easier said than done. Like, he's kind of, what are you going to do next? And you're going to start, shelling cities, innocent civilians. I mean, there's 40 million people that live in the Ukraine, which is just, I didn't realize it was that big.
I know it. I was. It's so funny. I was surprised too that there were that many people that were living there, and the ramifications of this are so much further too. I I know of a company here in Chicago that outsources their entire IT department to a group in the Ukraine.
Yeah, yeah.
So I haven't talked to them, but wow.
No, I've got a buddy that outsources a lot of stuff. He does a lot of website building, like online marketing type stuff, and a lot of that coding is done in the Ukraine, and it's it's pretty crazy to see all these. We're used to seeing these homeless. Um, People just kind of being displaced from these poverty-stricken areas. But with the Ukraine, I mean, you're seeing people walking around in their Canadian goose jackets, and people that probably have, like, it's very bizarre.
They really, it appears as though they didn't see it coming. But anyway, all right, let's talk lumber. It is
Yeah.
March 1st. I cannot believe it's March 1st. What the heck
Yeah,
happened? What happened to February?
yeah, Fat
Well,
Tuesday. So
it is Fat Tuesday indeed. Now, first, I'd like to apologize to our users and listeners for last week. That was a technical snafu on my part. I thought I knew what I was doing, and evidently I didn't. Um, we're making some changes behind the scenes here to make this go more smoothly. Um, but one of the things that we talked about last week that is really important, and I really want to highlight again, let's talk about that um, the limit change that's going on. So, all right, perfect. What's going on?
yeah, so just so everybody understands, today is March 1st. We're officially in the spot month. So just like in the past, March is your spot month contract. There are no price limits in March. That remains the same. What lies ahead starting next Monday? Um, we're going to go from $30 and $45 limits. We currently have a $30 limit. We're locked limit in May and July. So technically today, May is considered your front month. If you close limit up today in May, then tomorrow you get the expansion out to $45. Come Monday, the way that this is going to change is you're obviously going to have an expansion of float out of those price limits from 30 out to 57. If you lock at 57, limit up, limit down, then you would have an expansion out to $86. The big difference between today versus starting Monday is that that limit is going to be based upon the first 2 months. So if either May and or July close limit up or limit down, then one can trigger that expansion of the price limits. It's not going to be solely reliant on that front month like it is today. It's going to be either May and or July. So, that's kind of the big difference. And then, like, what's the logic behind all this? Well, it's pretty simple. It's just the CME is trying to float out the price limits to a 5% move. And when you look, you kind of start to average out the price over the last 30 to 45 days. All they basically did a rolling average on the daily prices, the daily price swings, and you basically came up with this 57, which is basically a 5% move. And so the CME, when you look at some of the other traditional markets like grains, like equities, they don't have daily price limits in the sense that they're not fixed. They're based upon a circuit breaker of a percent of the underlying contract value. So in grains, for instance, I don't know if we're still limit up here. I know we were close. Wheat for obvious reasons here because of the Ukraine, but basically you have 5% moves in a lot of these other markets. And when it triggers that 5% move, you lock limit, and then certain markets have a circuit breaker that goes into effect. You stop trading for 10 minutes, and then you expand out to the next band, which would be somewhere around 7.5%. Now that's not lumber right now, March 7th. We're still going to have these daily defined price limits, but I can tell you with the next creation of whatever lies ahead for lumber, you are going to move to that circuit breaker to eliminate this permanently. Where once they implement whatever changes are coming down the pike with lumber, you will have a circuit breaker based upon a percent change. So if lumber's trading at $400, well, you're going to have 5% of $400. If lumber's trading at $1,400, you're going to have 5% of $1,400. So that's the rationale behind why the CME is moving out to these expanded limits and what lies ahead. Because the reality is, when you have these circuit breaker type markets, markets don't lock limit, or they rarely lock limit, or they come off those limits. You have the ability to float out. Your price discovery happens much more in real time than having a market that trades limit for 5 or 7 days to ultimately get to that price discovery. And then,
Well, this is what these markets are for. It's for price discovery. You're not discovering a price if you're locking a limit.
right. So the other big thing I hear a lot of people bitch about, well, futures, how come we don't have $10, $15 limits? And, I think it's pretty funny. in that, well, wait a second, you trade cash. So your underlying cash market, does Fraser have a price limit? Does Canfor have a price limit? It's laughable in that your underlying physical cash market has no daily price limits. The mills can do whatever they want to do. You can do whatever you want to do. And if somebody's willing to pay for it, you float to that price. So that's all in a volatile market like lumber. The CME is just trying to figure out, how do you prevent a market from constantly locking limit? And again, I've said this time and time again, when you have a market that has, extreme volatility like lumber, you expose every imaginable flaw in the contract. And we've seen that play out time and time again here. So, the other big thing is, why is this taking 10 days? Why didn't they just implement this on when they put out the notice? Per CFTC regulatory rules, they have to give the underlying public, they have to give the public 10 business days notice before they implement these changes. That's why it's March 7th, 10 business days after they put out that notice. This will remain in effect until we go into that traditional semi-annual reset of pricing on May 1st. And, they're going to start to calculate. They are calculating those price limits. And I can't imagine if those price limits would be less than $57. No, 57 is going to be a minimum, not a maximum, as far as what that would evolve to on May 1st. So you're not going to magically just see $57 come back into $30 or $35. It's going to remain at 57 and be wider. And look, and this kind of, we'll jump into the next slide here. I know this is frustrating, but at the end of the day, this market is supposed to be liquid. Cash is traditionally your illiquid market. Futures is supposed to be the liquid part of the risk management tool here. And you got to bring that liquidity back. And unfortunately, in doing that, you're going to have to do it through price limit expansion. You have to have the ability to set prices, discover prices. You might not agree with those prices, but you have to have the ability to float to those prices on any given day.
Well, whether you agree or disagree shows in your activity, in your action. If you disagree with the price because you think it's too high, you can very easily sell it. And then maybe the price will go to where you agree that it should.
Yeah, no, and I think interestingly enough, and we'll jump into this the next when we talk about open interest, Mike. But amazingly, open interest continues to build. So for how illiquid this has been and these elevated price levels, you've gone from 2,400, 2,300 open interest out to above 20. You're back under 2,800 today, but we were just above 2,800. So for everybody that says they're not going to trade, you're obviously finding people willing to trade this, take advantage of these price swings.
Well, there's an underlying factor going on too, which is fascinating to me. So we were down at the IBS show, the International Builders Show, and I spoke to a lot of builders. And while the overall prices, they're not ideal for them from a cash flow standpoint, it doesn't matter what the price is. They're going to build that cost into their project, right? What they want is stability. So what they want is a long-term price. And across the board, what we were hearing is that their suppliers, the supply chain, was shortening the time that they would hold a price for them.
Sure.
So 90-day pricing, which kind of was the norm, has all of a sudden turned into 30-day pricing. So at a time where you have a customer that wants more long-term pricing, the pricing was moving the opposite direction in the cash market. So it doesn't surprise me that someone is stepping up and providing this long-term pricing, probably through the futures market, which is shown in the increase in open interest.
Yeah, no, and I think Alex Itzone and I see this every day. I literally have 3 calls later today. They're all with home builders, private equity developers, where who's bearing the risk now. Well, if somebody's not willing to give set pricing beyond that 30 days, traditionally you would get quarterly pricing. Well, obviously that went away, and now you're not even getting 30 days. You're getting, well, you're going to buy it this week. That's where we're going to set it when you come in and buy. So you're seeing, the segment that didn't exist for us from a future standpoint 12 to 18 months ago, the home builder, the private equity developer types, that's becoming the norm now, where those guys are assuming their own risk and actively, aggressively looking to do something about it because they understand the financial ramifications and are willing to do something about it. So you're
Well,
bringing new
there's an
participants into this market.
but there's an underlying reason why they're using futures as well. And it has to do with the structure of a futures contract, which means that counterparty is guaranteed.
Yeah.
And I think, the industry has done itself such a disservice by backing out of contracts. Um,
Yeah.
you know, there's nothing greater. There's no greater risk in a spot transaction, not in a forward transaction, than non-performance. If the other side walks away from the deal and you're left holding the bag.
Yeah, no, we've seen that time and time again, and unfortunately, you're likely to see that play out again. If we don't soft land magically out of these numbers, then that probably lies down the road sooner rather
Well,
than
I mean,
later.
I'd love to argue. I know it's probably not the truth, but it would be great if we had documentation and used the legal system that tied people to an agreement that they make. Um, this happens in other products and other commodities. The banks will come in and, you may be required to put margin up, even if you're a seller of the product, which
Yeah,
sounds,
no, amazingly, whether you're talking about futures, swaps, but just kind of industry participation in physical commodities. And you probably have 80 or 70 to 80% historical participation in other physical commodities. When you look at lumber, you're nowhere near that participation from an industry standpoint. And I think, unfortunately, that fuels the volatility, and that lumber is that seat of edge of the seat type mentality. Instead of planning ahead, it's what do we how do we deal about today and not think about tomorrow, and hopefully that begins to change. I'll jump forward. Um, so, this was as of, I think, the first week of February. You can see margining. Here's your spec margins were originally 6,600. So one of the byproduct of these wild price swings here is beginning like a month ago, we were at 6,600 for front month speculative. One contract cost 6,600. They increased it to 8,250. And then less than a week later, you had another increase. Again, here's your speculative front month, 8,250 out to 9,500. You can see back months 2 and 3. So this would be May and July. Uh, Again, you're in this 10,000 threshold, so you've had a pretty sizable increase in margining, and again, that's a different silo within the CME. So I've had a lot of people ask questions on, well, how does the CME calculate their margining? It's done on something called the SPAN system, SPAN margin. Standardized portfolio of analysis of risk. Basically, it's a combination of quantitative and qualitative metrics. Quantitative metrics, and I would say this is probably 80% of the equation that they use, is based upon historical volatility of a market, implied volatility. They have volatility floors based upon standard deviations. And then there's the qualitative metrics, macroeconomic conditions, geopolitical. So think of crude oil right now. Think of what's going on with the Ukraine and Russia. These are some of the things that can factor into the equation. But this is the one size fits all approach, in that they don't look at the nuances, or I've tried to get them to begin to look at the nuances of a boutique market like lumber, but this is your fire a bazooka, one size all approach for all markets. And this is something like with the price limit expansion, there's a 10-day notice. You're talking a 24-hour notice to do this. So this is something that the CME, based upon CFTC regulations, they have the ability to change these basically immediately within one business day.
and what's
And
important to know is this is the minimum. This is the
yeah, yeah,
minimum
yeah,
requirement on
yeah.
the futures commission merchants, the FCMs.
Well,
They can choose to, yeah, they can
Mike,
choose
it's
to
insane. I don't know if you knew this, but okay, these are the minimum margins set forth. So if you clear Stone, this is what you're getting charged. These margins right here. Stone does not have a markup in their margining. If you trade Interactive Brokers, I have clients that have IB accounts. They're margining spec margins for front month, second month futures are up over 25,000 per contract, like
Are you
20.
are you
Oh yeah,
serious?
25 to 28
Oh,
thousand dollars. So you're
wow.
talking three times, which is just insane, because of the volatility. So every to each his own. When a clearinghouse sees something that's highly illiquid or highly volatile, they have every right to these. Again, like you said, these are the minimum margin requirements. They can go whatever they want to go, and they do that.
Right. I, oh, we lost Greg there.
I'm here. Can you hear
Oh,
me?
so, yeah, we can. So I think this is an important distinction that many people may not know. But as far as the CME is concerned, there are no individual traders. The CME transacts with futures commissioned merchants. These are the
Yep.
clearinghouses. So they put the responsibility onto the clearinghouse to manage their customers, for the clearinghouse to manage their own customers. Hence the reason that you just said. And I had no idea that Interactive Brokers had such a high margin. But what Interactive Brokers is basically saying is we don't want lumber traders using our platform, and we don't want to take the responsibility of monitoring them.
Yeah,
Uh,
and so the other thing, people have to bear in mind is that when you trade a clearinghouse like Stone or ADM, some of the traditional futures FCMs, commodity merchants, you have something called a margin call. You have a 1-day call, hey, 2-day call, 3-day call. There's some leniency there as long as you don't have a net negative liquidating value. At a place like Interactive Brokers, there are no margin calls. If your account goes on a margin deficit, they blow you out of the position. There's an algorithm that automatically will reduce your position to take you off call. Now, I don't know if they give a notification and somebody can squawk in here if they've had to deal with the call, but if you go on call, there is no margin call. Hey, you got to meet this call on the next day. There is no margin clerk calling you. It, clearly takes you out. It will reduce your exposure to take you off call. So, again, this is the nuances to each his own as far as how the FCMs bore the responsibility, and you have somebody that deals with traditional physical commodities that assumes more of the risk. But at the end of the day, for the CME, it truly is a zero-sum game, and that at the end of the day, their books mesh. So whatever debits they have on the books, there's existing credits, and there really truly is no risk borne to the CME. It's all in the FCM's hands as far as, hey, at the end of the day, you're going to have a slush account that if you have this deficit, you're going to have funds available to take care of that deficit. You're going to go, to each individual trader, deal with those margin calls. But as far as the CME is concerned, that clearinghouse is clean every single day.
and while this may sound scary a little bit, to me, when I hear this, it tells me that there's integrity in this market because there's no functionality like this, no structure like this in the spot cash trades. You have non-performance. You have people walking away from deals, and because of that, the risk premiums that are built into the pricing, it tends to be higher when you're talking about a forward contract or a swap contract. Um, the non-performance risk has to get priced in.
Absolutely. No, that's a great point, Mike. Um,
So, it well, what we're talking about, it's important, and it's very important to understand. Um, Understanding why they do it and what it does for the market, which is adds the integrity to the marketplace. That no matter what happens, lumber futures will be there every day.
Yeah, no, absolutely, and that's where I truly, as much as we like to critique the CME, it's a world-class operation, and basically the risk parameters in place that are mandated from the CFTC, the NFA on down. There's a reason it functions the way it does. Because the other thing you have to remember, like in a swap deal, you have known counterparty risk. You know who's on the other side of this trade. When it comes to lumber, or when it comes to futures trading, it doesn't matter if you're talking lumber, the mini S&P. You don't know who that other counterparty is. You're meshed up with that other counterparty. It's unknown counterparty, but you know that there's a backstop that each counterparty has to honor their commitment, and that's the beauty of futures markets, in that you have those financial parameters in place, the risk parameters in place, that act as that guiding light.
For sure.
Um,
For
I know
sure.
we'll just jump through everything else here relatively
Yeah,
quickly.
let's talk about it.
Obviously, what's going on geopolitically has had a profound impact. Red line here is crude oil. Crude is traded up to $106. Brent crude, which is basically European crude, is up in that 110 area. So you can see, equities are kind of stumbling around here. Lumber obviously has made new highs now. And then the other one that stands out, which is beneficial, is 10-year notes. A week ago, we had talked about the fact that 10-year notes were in that 2% plus area. Now they've fallen back. I think I've seen as low today as this 1.6 area, 1.60. They were, the last time I had checked, they were 1.66. So you have flight to quality. You're seeing markets like commodities, crypto, gold, and I'll jump forward here. So here are physical commodities, and you can see the red line is gold, yellow line is lumber, blue line is crude oil, green line is wheat, the dark blue line is natural gas. So you can see how commodities as a whole have been the beneficiaries of the risk off in equities. What's going on with the geopolitical risk of what's going on right now. Um, Here's crude oil. I know a lot of people are talking about crude. Again, you're up in this 105 and a half, 106 area. Now you're within striking distance of, the all-time highs back in 2008 were in that 140 area. This is somewhere in the 113, 114 area. This is back in 2010, 2011. So you're within striking distance now of, okay, you've kind of crested through $100. I don't think that's a stopping point. I think this market has more room and potentially significantly more room to the upside, at least technically right now.
Well,
Um,
yeah, like we sit in this world of unknown. And I was listening to Bloomberg on my drive in this morning, and Barry Ritholtz said something uh, profound yet so simple. And he did the analysis of all the other geopolitical events that have happened and how the markets react to them. And of course, they react with putting adding in all the risk.
yeah.
Now, he says they generally overshoot. The initial move overshoots where everything ends up. But you find you get into this stage of the crisis, and yeah, people are going to all try to get out the same door at the same time.
Well,
So,
and again, the one interesting thing with crude oil is that even prior to the escalation of what's going on with the Ukraine right now, the underlying fundamentals, the backwardation of crude oil, the structure there was an undersupplied market with, organic, robust demand being very supportive. You were basically undersupplied and demand was increasing coming out of the pandemic. This just fuels that. And God forbid I use this word, but does it set the stage at some point if this doesn't come under control for stagflation? And to say that that's not a possibility now, it really puts a lot of pressure on the Federal Reserve as far as how much do you factor in what's going on geopolitically versus the underlying ramifications of interest rates lagging behind and all the inflationary pressures. It's just one more extraneous variable that the Fed's got to deal with that makes their job that much more difficult.
oh, yeah, without a doubt. So, speaking of the backwardation, the highest price I've ever seen in a 2 month spread today, $300 is the spread between March and July. What it
Yeah,
traded.
yeah, no, it's and we'll go over this in the next couple of slides, but weekly continuation. Obviously, we've made a new high. The next upside target on the weekly would be this 514 bar high. There's the 1540, I'm sorry, 1514 bar high, and then a 1540 gap. If I jump forward, I'll come back to this one, but here's your March. We talked about how you were stuck in this channel last week. Now you've officially broken out. So from an upside perspective, let's say that cash, we know that West Fraser was still 1380 this morning. realistically, all other mills are in this 1395 to 1420, 1425 area. So that kind of puts the upside potential in March to kind of stay lockstep with cash, where, the next big objective would be this 1420 area. And then I'll jump back here. Here's
Hang
your,
on, just hang on
yeah,
for a
I'm sorry,
second. We
Mike.
go back to that chart.
Yep,
This is just my opinion. Prior to the Ukraine crisis, I was getting pretty bearish. It looked to me like a big double top. Um, so I think it's important to not get myopic about the fundamental situation in cases like this. There truly is, and you can't underestimate what's going on with the Ukraine crisis, but in the back of your mind, I'm always looking at going, well, what if that wasn't going on? What would I have expected to have happened? And
sure.
I expected this market to start to drift lower and I thought we had topped out here. The Ukraine crisis is pushing us through this highs, but planning for the future, what if there is an orderly resolution to the Ukraine crisis? Uh, this market could roll over pretty significantly.
Absolutely. No, I think,
Yeah.
at the
Just
end of the day, it goes back to, okay, why do you have the structure? And is it supply constraint driven or is it demand driven? And at the end of the day, if there are supply constraint issues, you better have the underlying support of demand. Fundamentally, that demand better be there to support those higher numbers when you remove that supply constraint. And that's always the big question with lumber. Is this truly a demand driven event, or is this supply driven, supply constraint driven? And if it's purely a supply constraint issue with logistics, with rail cars, with trucking, and that demand isn't there to support these higher numbers as we move higher, then that's where you could get that event where you just roll over, like we witnessed a month ago, where prices collapsed from 1300 down to 900. And then so here's that convergence between cash and March. Um, and here's the basis. So a week ago, and again, you could make the case, right now March is 1373.80. So today it shows, and this is the beginning of the day, there were basically futures was trading at a $43 discount to cash. You could make the case right now, at least based upon last Friday's print, with March at 1373.50, you're within $7-8 of where print was last week. Now, I fully expect print to be up at least 10, if not $20 tonight. So, but you're at least narrowing. It's pretty crazy to think that March, less than a week ago, last Thursday, last Friday, March was down in this 12. You had flushed down, I think, as low as
1275.
yeah, 1275. So you're up $100, and the smart ones came in and bought that discount because it's the lesser of two evils. And buying, can you go buy 1380, 1400 in volume in the cash market? The answer is probably no. You had the chance to buy volume in futures on this last plunge over the last week here, and you know what? I forgot to add this, Mike. Let me pull this up, or let me move this into the screen here. I completely forgot to add this chart, but I know there were some questions on um, EFPs, and I have let me just
Oh,
pull
yeah.
this up. Let me pull this up here. So let me know if
Yep,
you
we see
can.
it. Actually,
Okay.
Joey, could you take the comment off the screen? It's covering up some of the stuff. Thank you.
Oh, there you go. Okay. So let me see if I can lower. There we go. So this is, and thanks to Alex at Stone for putting this together for today. But you can see March, we're up to 111 EFPs, how this compares with the previous two expirations, and then how it compares with the bull market structure that was in play last year, where March a year ago was up to 269, May was 389, July was 342. So, as of this morning, I think we were at 100, 111. And these are all your pre. These are all basically EFPs that have been pre-negotiated. So, the usual suspects kind of on both sides right now. doing their EFPs. And all I would say is that if you can't find the physical wood and you own March at a discount relative to cash, then you have the ability to sit here. Somebody's got to deliver the wood to you. If March goes to a premium where you can actually buy physical cash, then you would just take the money out of March and go buy the physical cash. But the longs have the luxury, and I'm going to remove this. So here's March. Sorry, let me get that out of the way. All right, that's gone. Okay. So here's the price curve. Here's March, here's May, July. You can see it's, and you talked about that, the difference between March and the July, how these spreads have all gotten blown out. And basically what's happened is March has had this meteoric rise back up to contract highs. And then you stair step down from there where all these back months have basically flatlined. So, again, for the forward guys, the developers, the home builders looking to lock in their lumber for July, September, November, and beyond, you basically get the benefit of really not that much significant appreciation in these back months. If you wanted to go buy these, you could buy these. And the flip side of this is, well, the reason you're not rallying in these back months is that for everybody that thinks this is a buy, somebody thinks it's a sell as well. So the sawmills, as much as they want to tell you that they believe 1330 is sustainable, forever, obviously actions speak louder than words. And when you see a build and open interest, for everybody buying this, there is somebody selling it, and it's pretty apparent that sawmills are very happy to build out their order files in these back months. And let's not kid ourselves, $1,000, July right now is 1,084, September is 987. Selling $1,000, averaging $1,000 between here to between May, July, September, into November. Yeah, those are pretty good numbers moving forward based upon your cost of production.
Those are really good numbers.
So like we've shown this chart before, and we've gone back. Lumber is officially back in this bull market structure, backwardation structure, where today you have cash in this 1380 to 1400 area. You've got March in the 1360, and then July down at 1084. In a bull market structure, these back markets, the back months rally to where your where your spot market is, where you constantly get rewarded to buy these back months. You get the appreciation to the upside. The one thing to watch here is going to be when you go to the reversion of the contango or bear market structure, where there will come a day where the expectation is that March goes off at 1400, May's at 1250, May's going to go up to 1400. There will come a day where these back months are leading indicators, and you don't get the appreciation in the back months. Rather, you get the depreciation. The spot market takes it to the chin and crashes down into these back months. So that's kind of what we're looking for, is this flip out of the backwardation structure back into the bear market contango structure. And again, this structure is typically more, the structure we have in play is probably more supply constraint driven. So at the end of this, the underlying fundamentals better be there to support these higher prices to justify $1,200, $1,300, $1,400 lumber prices.
For sure. There's no doubt about it. And the higher prices bring on the supply. So,
I'm just gonna. I know we're starting to run up, but here's July a week ago. July versus cash was at a $247 discount. So fast forward now, you're 325. And again, this was as of the settlement from yesterday, but you can see how these back months are just getting left behind right now relative to cash, relative to March. And so you see this in the spreads. A week ago, March, May was in that 105 area. We talked about the fact that it just didn't feel like the previous expirations that this spread was going to collapse in on itself. It had the potential to get blown out. And sure enough, you went from this 105 area. It traded as wide as 158 today. and I still think the spread can conceivably go out into that $175 to $200 area. And it becomes easier to do this so long as March drags behind physical cash. As long as your physical cash is going to lead the charge to the upside, then there's always going to be this need to buy the discount in March. I guess as we get closer to expiration, it's going to be interesting if March does trade at some kind of perceived value for the sawmills, where it trades even money or it trades at a premium to cash. You're probably going to see mills come in to sell it and deliver the wood at that point.
Agreed. Let's take a quick look at the open interest and the commitment of traders, and then I think we've covered a lot of ground here today.
Yeah, I know. We always run out of time. So here a week ago we were 2740. Today we're 2757. Sorry. But the trend is still moving higher. You're still seeing whatever liquidation you're getting in March, you're more than making up for in these back months, where again you continue to build open interest, and that becomes evident. Here's CFTC numbers from a week ago. Managed long commodity funds 457. Fast forward, you're up to 527, so they continue to chase the momentum higher. And again, you continue, here's your net change, you continue to build on a week over week basis. We continue to add contracts, which is good. That's probably why you're seeing less and less. I know today we have a limit day, but given the insanity, the volatility that spilled over until all the other markets out there, lumber actually has been probably one of the more liquid markets as of late. So I know everybody likes to, I'm going to run through these really quick, Mike. As far as rail car stats, we're kind of going sideways here. Here's Canada, it was making improvements, kind of declining again, and that kind of meshes up with the Western mills are telling people. Jump into the United States, and we're kind of back where we should be. So, it seems once the wood crosses the border, it seems much more normalized from a rail standpoint. I know today the CP voted to strike. They gave their notice to strike. They wouldn't be able to do it. I think there's a 15-day or 21-day window where they would have to try to negotiate before they could actually strike. But obviously there's significant rail issues that continue on in Canada. Last thing, Mike, I want to mention is that Alex and I are having a in-person lumber hedging risk management seminar. Here's my shameless plug. This is in person, StoneX headquarters in Kansas City, April 27th and 28th. We've held these in the past, and we get a good mix of people that attend. So anybody within the industry, from sawmills to home builders, developers, and everybody in between, will give exact details here in the future. But this is an in-person event, and the great thing with this is that StoneX has got really good education people that have come from the CME that are really good at explaining the fundamentals of futures trading much better than Alex and I can do. So we kind of relate this to lumber, but there's a crash course on risk management futures to start with that works its way up into lumber strategies.
That's fantastic. I couldn't recommend it enough. If you want to be successful in just about anything in life, it's all about training and education. So, take advantage of these opportunities when they come along, for sure. As long as, we're talking about non-lumber future stuff, let's talk about a few of the changes here. We're going to make available Greg's presentation. If you would like to get this presentation, this set of slides, emailed to you every week, what you need to do is send us your email address. So you can send it to me, Mike W. at materialsexchange.com. You can send it to Greg at Westline Capital. We're going to put together an email list, and we will send out the presentation so you can study it afterwards. The last thing I'd like to point out is that these are obviously free shows to watch, and we're not doing any advertising. Sans just a little bit of self-plugging here. This is our intention. We never will add advertising to this. What we want to do is make the industry a better place for everyone. We want to do education. What we ask in return is support us. We ask that you support Materials Exchange. We ask that you support Greg and Westline Capital, support StoneX, and that support can come in many different ways. It can come in participation in our markets. It can come in just word of mouth. But all we ask is a little bit of support. We really like to put these presentations on, and we're going to continue to do that. It's good for everybody, and quite frankly, it's been good for us. I will admit I've enjoyed it. It makes me keep my head in the game, and Greg does such a fantastic job of putting this together.
And the only thing I want to add, Mike, is that if anybody has any questions, commentary, you don't agree, you want to see something from a different perspective, you have a different perspective, by all means, chime in. That the idea is not to pontificate, and like this is evolving information. This is information that changes on an hourly, on a daily basis. So education wins, bottom line, and the more people become educated with this, the more they use your platform, the more they use futures. Where at the end of the day, in a highly volatile, highly illiquid market at times, it's to add transparency and price discovery, and that's all we're trying to accomplish here. Is instead of watching this stuff, use it, because it does work.
We live in a digital data world. So if you want to hide under a rock, go ahead. If you want to participate in the way the world operates in 2022, join the movement, get on Materials Exchange, trade futures, use the tools that are available to you. And some other tools are the other shows that we do at noon every day at noon. Ashley had a great show yesterday with Charles from Industrial Forest Products talking. He's the remanner who gives an excellent perspective of what it means to find value in the market and create value. We have actually a guest tomorrow. Kip Frothingham is going to be on Ashley's Wednesday show. Thursdays, Ashley talks with Matt Lehman, who truly has a unique way to look at the market. Right, wrong, or indifferent, agree or disagree, he looks at it through a different lens, and you can't say enough about different perspective and getting more data. And then on Friday, we're going to bring you new innovative discussions about what's happening in the market as we see it. So to wrap this whole thing up, it's about what Greg said, education. We're here to provide it for you. We just ask for a little support.
Yeah, and Mike, the other thing I'll add with all your shows is that I don't get a chance to watch all of them live, but because of the recordings, you go back and watch them, and there's a wealth of information that's shared between you guys and the different guests, where I think all shows are invaluable, and they all serve, they add a lot of value to the industry. So keep up the good work. Transparency wins in an industry that likes to hide behind the curtains. I think transparency benefits all of us.
Absolutely. All right. Thanks, everyone. And we'll see you next Tuesday, and have a safe week.
Thanks, Mike. I appreciate it.